Look, I'm going to show you something that's happening right now in the gold market that most people are completely missing. And when you see what I'm about to reveal, you're going to understand why some of the smartest money managers on the planet are making moves they haven't made in decades. Gold just crossed $3,900 per ounce. That's not a typo. While everyone's been distracted by the latest headlines, gold has been quietly screaming a message that central banks heard loud and clear months ago. And here's what nobody's talking about. This isn't just another bull run. This is gold confirming something far more significant about the global monetary system. Let me take you back to a moment that changed everything. Picture this. It's August 1971. President Nixon walks into the Oval Office and makes an announcement that would reshape the entire financial world. He's closing the gold window. No more converting dollars to gold. The Bretton Woods system, dead. Just like that, the dollar became what we call a fiat currency, backed by nothing but faith and the full credit of the US government. Now, here's where it gets interesting. For over 50 years, that system worked. The dollar became the world's reserve currency. Oil traded in dollars. International debt denominated in dollars. Central banks held dollars. It was the ultimate privilege, what the French called exorbitant privilege. The US could print money, and the world had to accept it because they needed dollars to function in the global economy. But something's breaking, and gold is the canary in the coal mine. Think about what gold actually represents. It's not just a shiny metal that people like to wear. Gold is a vote of no confidence. When gold rises, it's telling you that somewhere in the system, trust is eroding. And right now, gold isn't just rising. It's surging with a momentum we haven't seen since the aftermath of the 2008 financial crisis. The dollar index, the DXY, dropped over 9.5% recently. That might not sound like much, but in currency markets, that's an earthquake. The dollar is supposed to be stable. It's supposed to be the safe haven. But here's what's happening. While the dollar's falling, gold's exploding higher. That inverse relationship is telling us something critical. Central banks know this. They've been preparing for this. Let me give you some numbers that should make you sit up and pay attention. Central banks around the world have been buying gold at a pace we haven't seen in modern history. We're talking about hundreds of tons of gold being accumulated by countries that are clearly positioning themselves for something. China's been buying. Russia's been buying. India, Turkey, Poland, Singapore. These aren't random purchases. This is strategic accumulation. And here's the kicker. Many of these countries are part of what's called the BRICS alliance. Brazil, Russia, India, China, South Africa, and now they've expanded to include several other nations. And what are they all talking about? De-dollarization. Now, I know that word gets thrown around a lot. De-dollarization. It sounds like some conspiracy theory, right? Except it's not a theory when you can watch it happening in real time. These countries are actively working to reduce their dependence on the US dollar for international trade. They're setting up currency swap agreements. They're trading oil in yuan. They're discussing a new settlement currency that would be backed by commodities, including gold. Let me paint you a picture of what this actually means. Imagine you're running a country, and you've watched what happened when the US froze Russian dollar reserves. You saw how the dollar was weaponized as a tool of foreign policy. What would you do? You'd start thinking about alternatives. You'd start accumulating assets that can't be frozen, can't be sanctioned, can't be controlled by any single government. You'd buy gold. And that's exactly what's happening. The gold market is essentially confirming that the world is losing faith in the dollar's monopoly as the global reserve currency. This isn't happening overnight. This is a slow-motion reset that's been building for years, and we're now reaching a critical inflection point. Here's where most people get confused. They think the dollar is going to collapse tomorrow, that we're going to wake up and suddenly dollars are worthless. That's not how this works. What we're seeing is a gradual shift in the balance of power. The dollar will likely remain important, but its dominance is being challenged in ways that seemed impossible just a decade ago. Think about the mechanics of how this plays out. Right now, roughly 58% of global foreign exchange reserves are held in dollars. That's down from over 70% 2 decades ago. That might not seem like a huge drop, but in the world of reserve currencies, that's a massive shift, and it's accelerating. Every percentage point that shifts away from the dollar is a percentage point that has to go somewhere else. Some of it goes into euros, some into yen, some into yuan, but a significant portion is going into gold, because gold is the only asset that's truly neutral. It's not issued by any government. It can't be printed. It can't be devalued by monetary policy. It just is. Now let me tell you about something that happened in the COMEX gold market that should terrify anyone who understands how these systems work. The COMEX is where gold futures trade, where the paper gold market operates. And recently, we've been seeing something unusual. The amount of physical gold available for delivery has been shrinking while open interest, the number of contracts outstanding, has been growing. What does that mean in plain English? It means there are more claims on gold than there is actual gold to deliver. It's like a game of musical chairs, except the music is about to stop, and there aren't enough chairs for everyone who thinks they have a seat. This is what we call a squeeze. And when squeezes happen in commodity markets, prices don't just rise. They explode. We saw this with nickel a while back. We saw it with certain oil contracts. And if it happens in gold, if we reach a point where the paper market can't deliver physical metal to everyone who demands it, we're talking about a price discovery event that could send gold to levels that sound absurd right now. Some analysts are talking about $5,000. Some are talking about $10,000. And here's the thing. Those numbers aren't pulled out of thin air. They're based on what would happen if even a fraction of the money currently in financial assets decided it wanted to own physical gold. Let me give you some context on the scale we're talking about. The entire above-ground gold supply that's ever been mined in human history is worth somewhere around $15 trillion at current prices. That sounds like a lot until you compare it to global financial assets. We're talking about stocks, bonds, real estate, derivatives, all of it. That's hundreds of trillions of dollars. If just a small percentage of that money flows into gold, the price has to rise dramatically because there simply isn't enough gold to absorb that demand at current prices. And here's what makes this moment different from previous gold bull markets. In the past, gold rallied primarily because of inflation fears or currency debasement in specific countries. This time, we're seeing a structural shift in the global monetary system itself. This is about the architecture of how international trade and finance operates. Quick aside here, because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, how the storage works, what the rules are. Worth checking out if you're thinking about protecting some of your retirement savings with precious metals. Anyway, back to what's happening in the market right now. So we've established that gold is rising, the dollar is weakening, and central banks are accumulating. But let's dig deeper into why this is happening now. What's the catalyst? What's changed? Part of it is the sheer scale of money printing that happened in response to recent economic challenges. When you inject trillions of dollars into the financial system, that money has to go somewhere. Some of it went into stocks, some into real estate, some into cryptocurrencies. But smart money, institutional money, also went into gold because they understand that when you expand the money supply that dramatically, you're diluting the value of every existing dollar. But there's another factor that's even more important. Trust. The global financial system runs on trust. Trust that contracts will be honored. Trust that currencies will hold their value. Trust that the rules won't change overnight. And that trust has been eroding. When the U.S. froze foreign reserves, it sent a message to every other country. Your dollar holdings are only safe as long as you stay in our good graces. That's a dangerous message to send when you're the reserve currency. Because the whole point of a reserve currency is that it's supposed to be neutral, stable, above politics. Countries started asking themselves a question: if our dollar reserves can be frozen, are they really our reserves? And the answer they came to was no, so they started diversifying. And the ultimate diversification is gold. Now let me tell you about something that happened in the London bullion market that most people missed. The LBMA, the London Bullion Market Association, is where the global wholesale gold market operates. It's where central banks, major institutions, and large dealers trade physical gold in size. Recently, there have been reports of tightness in the physical market. Premiums for physical gold over the paper price have been widening. Delivery times have been extending. These are signs that the physical market is under stress. And when the physical market is under stress while the paper market is still relatively calm, that's a warning sign that something's about to break. Think about what happened in 2008. Before the financial crisis became obvious to everyone, there were warning signs in specific markets. The repo market started acting weird. Credit default swaps on certain securities started widening. People who were paying attention saw it coming. The gold market is giving us similar warning signs right now. Here's another piece of the puzzle: mining supply. Gold mining is a tough business. It takes years to bring a new mine online. Exploration, permitting, construction, it's a decade-long process in many cases. And here's the problem: we haven't been finding enough new gold to replace what we're mining. Peak gold discovery happened back in the 1990s. Since then, the amount of new gold being discovered each year has been declining. Meanwhile, the easy-to-mine deposits are being depleted. New mines are deeper, lower grade, more expensive to operate. This means that even as the price of gold rises, it's becoming harder and harder to increase supply. What happens when you have declining supply and increasing demand? Economics 101, price goes up, and we're not talking about a little bit. We're talking about a structural supply deficit that could last for years. Now, let's talk about what this means for the average person. Most people think of gold as something that rich people buy, or something that preppers hoard in their basement. But gold is actually a form of insurance. It's insurance against monetary instability, against inflation, against the kind of systemic risks we're seeing build up in the financial system right now. Think about your portfolio. If you're like most people, you probably have most of your wealth in stocks, bonds, maybe some real estate. All of those assets are denominated in dollars. They're all part of the same system. If that system experiences stress, if the dollar weakens significantly, all of those assets are at risk simultaneously. Gold is different. Gold moves inversely to the dollar. When the dollar weakens, gold typically strengthens. It's a hedge. It's diversification in the truest sense of the word. You're not just diversifying across different stocks or different sectors. You're diversifying across different monetary systems. And here's something most people don't realize. You don't need gold to go up for it to protect your wealth. You just need it to hold its value while other things lose value. If the dollar loses 20% of its purchasing power due to inflation and gold stays flat in dollar terms, you've actually lost purchasing power in your dollar-denominated assets. But if you own gold, you've maintained your purchasing power. That's the real function of gold. It's not about getting rich quick. It's about preserving wealth across time and across different monetary regimes. Let me tell you a story that illustrates this perfectly. Back in 1980, gold hit $850 an ounce. That was the peak of the last great gold bull market. At the time, $850 could buy you a nice men's suit. Today, gold is over $3,900 an ounce. And guess what? $3,900 can still buy you a nice men's suit. The purchasing power of gold remained constant while the dollar lost value. That's what gold does. It's a store of value across time. And in an era where central banks are printing money at unprecedented rates, where government debt levels are at all-time highs, where the global monetary system is undergoing a fundamental restructuring, that store of value function becomes incredibly important. Now, let's talk about what could accelerate this trend. What could be the catalyst that takes gold from $3,900 to $5,000 or higher? There are several potential triggers. One is a currency crisis. If the dollar experiences a sharp decline, if foreign holders of dollars start dumping their reserves, that could trigger a rush into gold that overwhelms the market. We've seen this happen in individual countries before: Turkey, Argentina, Venezuela. When a currency collapses, people flee to gold. Another trigger could be a sovereign debt crisis. Government debt levels around the world are at levels that would have been considered impossible just a few decades ago. The U.S. debt to GDP ratio is over 100%. Japan's is over 200%. At some point, the market starts questioning whether these debts can ever be repaid. And when that happens, the currency that debt is denominated in comes under pressure. A third trigger could be a breakdown in the paper gold market. If we reach a point where the COMEX or the LBMA can't deliver physical gold to everyone who demands it, if the paper market loses credibility, we could see a rush to physical that sends prices parabolic. And here's the scary part: these triggers aren't mutually exclusive. They could all happen at once. A currency crisis could trigger a sovereign debt crisis, which could trigger a breakdown in the paper gold market. It's all interconnected. Think about the derivatives market. There are trillions of dollars in gold derivatives outstanding. These are contracts that derive their value from the price of gold, but they're not backed by physical gold. They're just paper promises. If confidence in those paper promises breaks down, if counterparty risk becomes a concern, the entire structure could unwind very quickly. We saw what happens when derivative markets unwind in 2008. Lehman Brothers collapsed because of derivatives exposure. AIG had to be bailed out because of derivatives. The gold derivatives market is smaller than the credit derivatives market that blew up in 2008, but it's still large enough to cause serious problems if it unwinds disorderly. Now, I want to talk about something that doesn't get enough attention: the role of gold in the new monetary system that's being built. Because that's really what's happening here. We're not just seeing the dollar decline. We're seeing a new system being constructed to replace or supplement the dollar-based system. The BRICS countries have been working on this for years. They've established the New Development Bank as an alternative to the World Bank and IMF. They've set up currency swap lines so they can trade with each other without using dollars. And they've been discussing a new settlement currency that would be backed by a basket of commodities, with gold playing a central role. Now, this new currency isn't going to replace the dollar overnight. That's not how these things work. But it doesn't have to replace the dollar to be significant. It just has to provide an alternative. And once there's a credible alternative, once countries have a choice, the dynamics change completely. Think about it from the perspective of a country like Saudi Arabia. For decades, they've sold oil exclusively in dollars. That's the petrodollar system. But now they're being offered an alternative. They could sell oil to China in yuan. They could accept payment in a BRICS currency. They could even accept payment in gold. Why would they do that? Because it gives them options. It gives them leverage. It reduces their dependence on the U.S. financial system. And for a country that's trying to navigate between different great powers, that optionality is valuable. And here's what happens when the petrodollar system starts to break down. The demand for dollars decreases. If countries don't need dollars to buy oil, they don't need to hold as many dollars in reserve. And if they're holding fewer dollars, they need to hold something else. Gold becomes that something else. This is why gold's rise isn't just about inflation or monetary policy. It's about a fundamental restructuring of the global monetary system. It's about the end of the post-1971 dollar-dominated era and the beginning of something new. Now, what does this mean for the timeline? When is this death date for the dollar? Here's the truth. There isn't a specific date. This is a process, not an event. The dollar isn't going to collapse on a Tuesday afternoon. But we are in the middle of a transition that could take years or even decades to fully play out. However, there are inflection points, moments where the pace of change accelerates, and the signals we're seeing in the gold market suggest we might be approaching one of those inflection points. When gold moves this aggressively, when it breaks through major resistance levels and keeps going, it's telling us that something significant is happening beneath the surface. Professional traders watch gold for this reason. It's a leading indicator. It often moves before other markets react because the people buying gold, the central banks and large institutions, have access to information and analysis that the general public doesn't see until later. So when you see gold at $3,900 and climbing, you should be asking yourself, what do they know that I don't? What are they preparing for? Let me give you another historical parallel. In the late 1970s, gold went from $35 an ounce to $850 in less than a decade. That's a 24x increase. It happened because the dollar was losing credibility due to inflation, because trust in the monetary system was breaking down, because people were looking for alternatives. We're seeing similar dynamics today, but on a much larger scale. The amount of currency in circulation is vastly larger than it was in the 1970s. The level of government debt is vastly larger. The complexity of the financial system is vastly greater. If we see a similar loss of confidence today, the move in gold could be even more dramatic. Some people look at gold at $3,900 and think they've missed it. They think it's too expensive. But here's the thing. Gold isn't expensive or cheap in absolute terms. It's only expensive or cheap relative to other assets and relative to the amount of currency in circulation. When you adjust for the expansion of the money supply, when you look at gold relative to the total amount of dollars in existence, gold is actually not that expensive historically. In fact, by some measures, it's still relatively cheap compared to where it was at previous peaks. And here's another way to think about it. If gold is insurance against monetary instability, and if monetary instability is increasing, then the insurance is actually becoming more valuable, not less valuable, as the price rises. Think about homeowners insurance. If you live in an area where hurricanes are becoming more frequent and more severe, the insurance becomes more valuable even as it becomes more expensive. You don't say, well, insurance is expensive now, so I'm not going to buy it. You buy it because the risk is increasing. That's where we are with gold. The risks in the monetary system are increasing. The probability of significant dollar weakness is increasing. The likelihood of inflation remaining elevated is increasing. In that environment, gold becomes more valuable as insurance, not less. Now, I want to address something that comes up a lot. What about other alternatives? What about cryptocurrencies? What about other precious metals like silver? Cryptocurrencies are interesting. They offer some of the same benefits as gold. They're not controlled by any government, they can't be printed at will, they're portable and divisible. But they also have significant differences. They're much more volatile. They're dependent on technology and infrastructure. They don't have thousands of years of history as money. Gold has something that cryptocurrencies don't: universal acceptance. Every central bank in the world recognizes gold as a reserve asset. Every culture throughout history has valued gold. That's not true of cryptocurrencies, at least not yet. Could cryptocurrencies play a role in the future monetary system? Possibly, but they're not going to replace gold. They're more likely to coexist with gold, serving different functions in different contexts. Silver is interesting too. It's often called poor man's gold because it's more affordable and more accessible. Silver also has significant industrial uses, which gives it a different demand profile than gold. When the economy is strong, silver often outperforms gold because of industrial demand. When there's monetary instability, gold often outperforms silver because of its monetary role. Right now, we're seeing both monetary instability and strong industrial demand for silver, particularly from the solar panel industry and the electric vehicle industry. That's a powerful combination. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically high. If that ratio reverts to more normal levels, silver could significantly outperform gold. But here's the key point. This isn't about choosing one or the other. This is about understanding that we're in an environment where hard assets, tangible assets, assets that can't be printed or devalued by central banks, are becoming more important relative to paper assets. The traditional 60-40 portfolio, 60% stocks and 40% bonds, that model was built for a different era. It was built for an era of stable currencies, moderate inflation, and predictable monetary policy. We're not in that era anymore. In the current environment, you need diversification beyond just stocks and bonds. You need assets that protect against currency debasement, against inflation, against systemic risk. Gold serves that function. Silver serves that function. Even some cryptocurrencies might serve that function, though with much higher volatility. The point is to think beyond the traditional framework. The rules are changing. The monetary system is evolving, and your portfolio needs to evolve with it. Let me bring this back to the core message. Gold at $3,900 is not just a price level. It's a signal. It's the market telling us that something fundamental is changing in the global monetary system. The dollar's role as the unchallenged reserve currency is being questioned. Alternatives are being built. Central banks are positioning themselves for a different future. You can choose to ignore that signal. You can assume that the system that's been in place for 50 years will continue indefinitely. Or you can recognize that we're at an inflection point, that the next decade is likely to look very different from the last decade, and position yourself accordingly. This isn't about fear. This isn't about predicting doom. This is about recognizing reality and adapting to it. The smartest investors don't fight the trend. They don't ignore the signals. They pay attention, they adapt, and they position themselves to benefit from the changes that are coming. Gold is telling us that change is coming. The question is, are you listening?